Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Jack Forehand is a principal at Validia Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital or Sunpoint Investments.
Hey guys, this is Jack. In this episode of Excess Returns, Matt and I sit down with NYU professor Aswath Damodaran. Aswath needs no introduction, and his work on valuation and his willingness to freely share it has had a huge impact on many investors, including us. Aswath has just released a new book, The Corporate Lifecycle: Business, Investment, and Management Implications. And we dig into that concept and what it means for the valuation of companies. We also wanted to get Aswath's take on some issues he isn't often asked about that many investors are thinking about today. We discuss his views on factor investing, market concentration, the rise of passive investing, and a lot more. He also explains why, despite making trips to Omaha, he's never stepped foot into the Berkshire Hathaway annual meeting. Aswath had so many great insights that we went a little longer than usual, but we promise you'll find a ton of value right up until the end when he explains the one lesson he would teach the average investor. Thank you for listening. Please enjoy this discussion with Aswath Damodaran.
We are here today with the Dean of Valuation. I think we've established this already. Professor Aswath Damodaran, you are here. We are mispronouncing your name at our leisure. I got to start you with this thing. I'm excited. You've got a new book. Congratulations.
Yes, this is my 12th book. And, I've never, ever sat down to write a book in my life. I write stuff, and if it accumulates and reaches a critical mass, eventually I say, look, I've got a book here, and does anybody want to publish it? And somebody usually does. So this is a book on the corporate life cycle. It reflects two things. One is we're all aging. And as we age, we understand that aging brings with it some privileges. We no longer have to ask our parents whether we can go out for the evening or whether they can borrow the car. We get financial independence, but it comes with limits. In fact, most people think about the limits rather than the benefits. But the reality is aging comes with privileges and limits. And it's that recognition that I brought into business, because I feel businesses go through a similar process. They age, good stuff happens, bad stuff happens. And just like human beings, companies and businesses fight aging. Nobody wants to get old. One of my favorite sayings is, growing up is optional, but growing old is mandatory. And companies refuse to accept that reality. And there's an ecosystem that tells them they don't have to be old. They can be young again. Just like there's an ecosystem around human beings. That ecosystem consists of plastic surgeons and physical trainers saying, you can be young again. They're lying, but we buy into it because we so want to be young again. With companies, it's consultants and bankers telling them they can be young again. Just do this. I remember about 5 years ago when Walmart bought Flipkart, the Indian online retailer. And Walmart by 2019 was a middle-aged company. Nothing wrong with it. They made it to middle age. That's already an accomplishment. We'll talk about the mortality rates. But they didn't want to be middle-aged. They wanted to be young. They wanted to be a growth company. And I called it the most expensive facelift in history because it paid $21 billion to buy an Indian online retailer. Did it make them young again? Not at all. But will they stop trying? No. So the reality is there is a great deal of commonality between what we as human beings do as we age and what businesses do. And some of the most dysfunctional actions on the part of businesses come about because they refuse to act their age. They want to be young again. Old companies trying to be young companies trying to be old. I don't do consulting, but if I were a consultant, I would be fired 15 minutes in because I would go and my advice is just act your age. That's pretty much the advice I would give to any company. The healthiest thing you could do as a company is to act your age.
So speaking of acting your age, and I hope you make it more than 15 minutes into this consultation here today, I have a question. I love this book. This one is one of my favorites that you wrote. And there's nothing age about this. I'm not saying you forgot you wrote the chapter here on the corporate life cycle.
Right.
But I take moderate issue because I love this back part of this book so much. And I've had so many, when was this? 2019, 2017?
2017. And in fact, it reflects something else I started saying. I I've taught valuation now for close to 40 years. I did my first valuation in 1981. I did it with an annual report and a ledger sheet, a paper and a calculator. That's how old I am. But one of the things I noticed as I looked at appraisals and valuations is our access to data became much better. And we could, you couldn't go to S&P Capital IQ Facts and download the last 25 years of data, not just in your company, but in every company in the sector. In seconds, you have more powerful tools. I work with a calculator and a pencil. You have Excel spreadsheets, you can build macros. If you're really sophisticated, you can bring in Python. And I noticed a contradiction. We had more data, more powerful tools, and our valuations were actually became qualitatively worse. The question I started asking is, what's going on? Why is the data and the more powerful tools not translating to better valuations? And my answer was, and I could be wrong, is that we've forgotten that every valuation, you're telling a story. Whether you like it or not, when you put numbers for a company, you're telling a story about the company. And it's your job to make the story explicit and ask yourself, do I buy that story? We've forgotten that art of storytelling because much of valuation has become financial modeling. You're an Excel ninja. You know what buttons or what keys to hit to turn every other row a different color, but you've forgotten that every valuation is a story. So that book reflected the reality that we've forgotten the art of storytelling and that without stories, valuations has become numbers on a spreadsheet. So that book actually reflected my desire to bring back stories to valuation. Something that I've had a role in driving out because people looked at books like mine and thought equations and models would basically give them valuations. And it was my response to saying, look, you might have learned all these tools from my books, but they're not going to help you value companies unless you understand how to tell a story about a company. And in fact, that book ties very well with the corporate lifecycle, which is when you tell a story about a business, you're not a fiction writer. You can't write fairy tales. We might want happy endings. Hey, you're writing a story about Bed Bath & Beyond. It's going to be a horror story, whether you like it or not, because the reality is there is no light at the end of the tunnel. I call this bounded storytelling, which is you tell stories that reflect where your company is. And I think that there are I'll throw out two companies and I want you to, your audience to think about where they would, what they would do as stories for these companies. Two companies are in trouble right now. One is Intel and the other is Starbucks. Two companies that used to be superstar companies at a point in time. Clearly they've hit the skids. They both, one of them has a new CEO brought in from Chipotle. And that's again a question. Can hiring a new CEO give you new life? But the question is, what is the story you would tell for these companies that might lead them back to the promised land, or at least to middle age? Because clearly these companies are teetering on the edge of that worst phase of the life cycle of decline. The market seems to have decided that Intel is not just middle-aged, it's old. And I think the question is there a way back? And that's, I think, what you need to think about when you think about valuing or investing in companies is where is this company in the life cycle? What can it do realistically to keep going? And raise a question that I think, some business school professors might find sacrilegious. Should it keep going? I think there is this, and I've argued against both ESG and sustainability as bullshit concepts packaged very well by Harvard Business School professors and marketed by consultants. Sustainability in particular, I've never quite understood. I can understand wanting to make the planet more sustainable. We live on the planet. We want it to be sustainable. But what does it mean to make a company more sustainable? Do you want Philip Morris, or Altria as they call them, to be sustainable? Do you want people smoking cigarettes for the rest of eternity? Or do you want companies to go away when the time for them is past? I believe there's a time for companies to fold. Now, the old Kenny Rogers song is time. Well, you need to know when to hold them. You need to know when to fold them. And there are some companies where the best the healthiest thing you can do is say, look, we had a great run and it's time for us to go away. And I think that's something we have to accept in businesses. A company in particular is a legal entity. If the reason for its existence is gone, why should it stay on?
Something I love in this book that I think ties back to the old book that I wanted to reference here in this is in those chapters in the story, and kind of what you're just saying, you could tie this back to an Intel or a Starbucks or any of the others. This idea of the story is first about why is this a better mousetrap that the company has presented?
Mhm.
The next layer, how do we convince investors to give us the money? Where can the money come from? Either internally, management saying allocate resources here, or externally, investors give us this money, let us borrow this money, let us raise this capital. And then not just convincing customers to buy it, but convincing the employees to build it too. And you point out that shifts.
Yeah. And I think that building a business model is a vastly underrated skill. I think for 2 decades now, we've celebrated entrepreneurs because they have great ideas. You know what happens to most great ideas? They never make it to a product phase. And many companies that make it to a product or service don't make it as businesses because it's a different skill set. The visionary who comes up with ideas might not want to sit in on a 3-hour supply chain meeting. But if you need supply chains for your product to get to customers, you need to be interested in manufacturing and supply chains. It's a point I make is we think about great business people, but the kinds of people you want running your company are very different when you're an idea company than when you're a business building company. And again, it shifts when you become a growth company, when you got to become an opportunist, think about where. And then if you're a mature company, it's about playing defense because everybody's coming after your market. That's why this notion of a great CEO, again, marketed by the Harvard Business Review and McKinsey, it's very self-serving on the part of business school professors and consultants to market the idea that there's a certain set of characteristics that make for a great CEO. It's absolute nonsense because you look at the list of characteristics and then you look around you and say, hey, that guy is a great CEO. He has none of these characteristics. But they want to market this package because if they can convince you that there's a package, then they can charge you $250,000 for getting an MBA where they will deliver the package to you, or to hire McKinsey to come in and tell you how to get the package. There is no one package. It's going to vary across the life cycle, which means management tasks, their challenges are going to be different. The kinds of people you want running the company are different. And I make this point in the book, and it's going to get only more difficult to deal with this in the 21st century than the 20th century. And here's why. Let's take the classic 20th century company, an amazingly successful 20th century company, GE, right? It's actually a 19th century company in terms of when it was founded, 1892, I think. But it lasted 120 plus years. It's now dead and gone, broken into pieces, and we can talk about why those pieces survived, but it lasted 130 years. You can take Ford, you can take GM, you can take, the companies of the 20th century were long-lived enterprises, but it took them a long time to get from zero to being big companies. Think of when Ford was founded, when Ford became a large company, 50, 60 years, because scaling up was difficult, capital-intensive businesses, 130 years. So here's what happened. Henry Ford was the perfect CEO for Ford in 1902. Visionary. But remember, visionaries are kind of eccentric. And that's the reason the Model T came in one color, black or black. It's just like, Steve Jobs' iteration 1 in Apple saying, I'm going to make a computer where you cannot expand, no new memory because I don't like that. But he was the perfect CEO for Ford to break the mass market automobile business open. Towards the end of his tenure, he was outliving his welcome. But time took care of the problem. He died, somebody else moved in. Time took care of transitions with the 20th century company. In contrast, think of Yahoo and BlackBerry, right? Both founded in the 1990s, went from 0 to 100 billion, in the case of Yahoo, in 8 years. Amazing. Lasted at the top by 3 to 4 years. Then went into decline. The day Google went public, Yahoo was started its decline. By 2015, gone, 23 years from start to finish. And that is more the 21st century company, But, much of what I do online, I do on Zoom. I like the technology, but if you think Zoom's going to be around for 100 years, you're being delusional. This company, even if it's successful, is going to have a 20 to 25-year run. And the problem is the same people are running the company while it's a young growth company as when it's a declining company. And there are very few people of the skill sets to essentially match up to the company as it ages under them. We're going to have a lot of issues with companies in the 21st century where management that we thought were heroes just a few years ago are going to be zeros. And here's the problem. While this is going on, we've decided as shareholders, we don't need the power to change management. We've gone along with companies, especially companies, the 21st century companies, with two classes of shares. And guess who owns the voting shares? The founder CEOs. We've essentially created a calamity for ourselves. I mean, a couple of years ago, you saw this play out at Facebook, where portfolio managers said, hey, how do we get Mark Zuckerberg to listen to us? And my response was, buying Facebook and complaining that Mark Zuckerberg is not listening to you is like getting married to a Kardashian and complaining cameras fall away all over the place. You gave up that power, and we've given up the power to change management at exactly the time where we need the power the most. So as you look across Google and Facebook and all of these companies, two classes of shares, it's terrifying to think about what do we do if the people running the company are not matched up to the company. How do we get them out of the positions of running the company?
How do you think about the relationship between narrative and reality? I was thinking about your example with Intel, and if I wanted to change their narrative, I probably would want to do something around AI, but the problem is they can't really deliver on AI. And you can argue in different times in Tesla's history, Elon Musk has maybe set the narrative very well, maybe with things that he couldn't even deliver. So how do you think about that, like the role of a CEO in setting that narrative relative to reality?
It's got to be bounded storytelling. I mean, that's why I described it as, in fact, in Silicon Valley, they understood the importance of story, but their storytelling was they taught founders how to tell big stories, bigger stories. I mean, you see this play out when you look at the total addressable markets has become a feature of almost every Silicon Valley company. When Uber went public, they claimed their total addressable market was $5.2 trillion. You know how they came up with the $5.2 trillion? They spent every dollar people spent not just on car service, but on buying cars, on public. They basically took everything anybody spent on transportation and said, that's our total addressable market. You know why they liked the $5.2 trillion? You hold up $5.2 trillion in front of investors' eyes. They said, this company could become huge. But it's a fairy tale. There is no way that car service is going to be a $5.2 trillion business. So one of the things I have as a problem with storytelling, and let's face it, venture capital is all storytellers. Founders are storytellers. It's all stories, but they're undisciplined storytelling, where you don't kind of capture the bounds of that story based on reality. In fact, I have what I call the 3P test. Is it possible? Is it plausible? Is it probable? I created it in the process of writing the narrative and numbers book. That's basically something I constantly come back to when I hear a story. Now, it's going to be interesting. I'm waiting for the Starbucks CEO to stop commuting to work in a commuter jet, 2 days a week from wherever he's living in California to Seattle, and tell us his story for Starbucks. I'm fascinated because I don't see a bounded story you can tell for Starbucks that brings them back to growth. Maybe it can stem the bleeding, but there's no growth story I can tell for Starbucks. Because let's face it, the Chinese market, it can't compete because its costs are too high. The Chinese coffee companies can sell at half the price that Starbucks does. In the US, the market is saturated. And they've blown up their own story. The original story for Starbucks, at least the Howard Schultz story, was that you'd wander into this nicely decorated cafe, you'd order a cappuccino, you'd sit at that table, you'd use the Wi-Fi, and over the course of the next 3 hours, consume half of the universe while you were sitting there. A scone, a sandwich, have another coffee. It was supposed to be a meeting place. And then came COVID, and Starbucks, of course, switched to online ordering. And with online ordering, their story blew up because their sales now have shifted increasingly to online sales. You walk into a Starbucks, there's a stream of people who walk in, pick up their coffee and it's entirely destroying not just their story, but their basic business model. Because the people who come in and order at the cash register now find themselves waiting 20 minutes because there are online orders ahead of them. And I'm not sure how you walk that back. Okay. So and that's why I threw Starbucks and Intel into the picture is what story can you tell? I think there is a glimmer of a story you can tell for Intel because the hope comes from the AI market being a big one and NVIDIA dominating it. And Intel maybe finding a way into that market. Maybe it's too late. I don't know, but they have the skill set. They have the R&D. But I think that whether the lead time is too long and NVIDIA has run away from them, I don't know. But I could tell a plausible story for Intel to make a comeback, at least as a middle-aged company with AI providing. But what's giving it that extra space is there's a big growing market, AI, that potentially they could be part of. With Starbucks, there is no big potential market out there that I can see except, hey, they can add that on and maybe go back to being middle-aged or even high growth. So I think when you look at stories, I think the questions you need to ask are not math questions. They're not data questions. They're common sense questions. And when you hear these plans put out, my problem with the plans is the plans are often stated in terms of numbers. We're going to grow 20% a year. Where? Doing what? Our margins are going to improve by 5%. By cutting what? I mean, people think that coming up with a plan, and equity research analysts are just as much to blame for this, is to map out numbers. I need a story of where that extra growth is coming from. What's going to cause your margins to improve? So this notion of storytelling will actually make you more disciplined in your numbers because it forces you to ask, hey, where is that coming from? What is this company going to be able to do? Is it plausible? Can they pull it off? And I'm glad you brought up Tesla because Tesla in many ways is a fascinating company in terms of where you put in the life cycle. It's a company that I call my corporate teenager when I bought it for the first time in 2019. I know whether you have teenagers in your house or you're familiar with teenagers, but you know what teenagers do. Every day they wake up, they look in the mirror and they say, I have lots of potential. What can I do today to screw it all up? It's the teenage tendency. And Tesla in many ways has a great storyline. I mean, let's face it, it's created the electric car market when people said it was not. I mean, go back to 2008. Look at what the status quo, the legacy automakers were saying about electric cars. And look at how much the game has changed on electric cars. And Tesla is responsible for that, and Elon Musk. But at the same time, this is a company that constantly steps on its own storyline. By doing what? By doing things that, the heck are you guys even thinking about? Why would you want to bring Bitcoin into the picture? But that's the nature of corporate teenagers, is they don't have focus, but there's no point complaining about it. It's a package deal. You get Elon Musk, you get his pluses, you get his minuses. I think he's a net plus for Tesla still. I own Tesla. But I think this is a company where you're constantly going to be searching for what's the storyline? What kind of company is it? Is it an automobile company, an energy company, an automated driving company? It's a company where the story keeps shifting. And getting the bounds in the story gets really difficult to put.
I want to ask you about value investing, so I guess we're going to go in a little more boring world than Tesla here. But I want to start with Berkshire Hathaway's annual meeting, because I heard you talking in another podcast that you've been in Omaha, and I believe you've been in Omaha during the annual meeting, but you've never stepped foot inside it. Can you explain why?
The place terrifies me. It's full of true believers who think they've found, the three words that come to my mind when I think about old-time value investing, I'm not tarring Warren Buffett or Charlie Munger with this, is it's rigid. It's ritualistic, right? There are certain things you're supposed to do as a value investor, including going to Omaha, reading Ben Graham's security. And I'll wager for every 100 people who claim to have read Ben Graham's security analysis, maybe one actually read the book. I've actually read the book. I've written hideously boring books, but next to Ben Graham, my books are like, Harry Potter to read. And you're supposed to follow those, it's very ritualistic, it's very rigid, and it's very righteous. The righteous part really bothers me, which is they believe they're the chosen ones. You hang out with people who come to Omaha, they've been coming for 30, 35, 40 years. They think they found the one pathway to successful investing. And I have no problem with all of that. But then they look down at the rest of the world as shallow and stupid and not quite there. And I think that's one of the most dangerous things you can do in investing, is to view the rest of the investment world with contempt because you've done the right things. So I don't feel any joy in hanging out with a crowd that's convinced that because it becomes almost a religion rather than, I have faith. I tell people investing is about faith. I have faith, but I don't believe in dogma. And a lot of old time value investing has become dogma. You cannot do this. You should be doing this. You have to have a margin of safety. Says who? Right? So I think that's what bothers me about old time value investing. And again, I think that Warren Buffett is actually a much more flexible investor than many of the people who claim to follow Warren Buffett. But I think old time value investing has created these sets of rules that they believe everybody should follow. And to me, there is no one pathway to success. I love Peter Lynch. I love Warren Buffett. I like what some things that George Soros does. I think there's something to be learned by looking at great investors in every philosophy. And if you ask me what's the best philosophy for me, my advice is look inward. Now figure out what makes you tick, because that's going to tell you what the right philosophy for you is. It's not what worked for Warren Buffett, it's what's going to work for you.
Is there value in dogma? Is there an upside to dogma?
Yeah, you don't have to, there's no debate, right? The upside to dogma is you'll never buy a stock with a PE ratio greater than 10. That makes it very, very absolute. They have less work to do. But your portfolio is not going to thank you for your dogma. So the upside of dogma is you never have doubt. Yeah. I tell people, when people say, do you feel uncertain about your valuations? My reaction is, of course I feel uncertain. Why? Because I'm not God. I am playing God. I'm making these judgments. I'm going to be wrong. And I think the problem with dogma is you're never wrong. The rest of the world is wrong, but you're never wrong.
This gets to this overall idea, too, of combating confirmation bias. It's something I struggle with all the time. Like, do you have any tips on that? Like, I mean, part of what I do with this podcast helps me because I interview people all the time that have different opinions than me. But is there anything you do if you have something you feel really strongly about investing to try to challenge that from time to time?
No, I just try to be honest with myself. I mean, that's all you can do. You can't make bias go away. We're human beings. We're predisposed to be biased. You buy something to put in your portfolio, whether you like it or not, from that day on, you want to find that thing to be undervalued because you want confirmation that you did the right thing. So I think then there are two things I would do though. One is don't let confirmation bias make you double down. That's one thing you should never do. Doubling down is you buy something, it halves in price. You're saying, I am convinced I'm right. I'm going to go buy more of it. Don't double down, right? Second, allow yourself doubt. And that's why I use the word faith. The essence of faith is your faith will be shaken. Accept it. So if you wake up and say, I bought that stock, I bought, Palantir, I thought it would go up more. It hasn't gone up. No. Did I make a mistake? Yes, you could have made a mistake. The essence of faith is you accept the fact that you might have missed something, that there could be. Now, I call this keeping the feedback loop open. It's a fifth step in my storytelling, where after I've told a story and valued a company, I try to be open to people pushing back. And rather than get defensive, I ask myself, is there something I can borrow from what they're telling me to make my story better, to make my story different? It's tough to do, and we all want to be right. We all want to defend what we've done. But I think in the process of doing it, you often make your biases worse. Okay? So I think that all you can do is be honest with yourself. And maybe if you're honest with yourself for enough time, it becomes easier. No. One of the things that's helped me is because I write a blog and I put down pretty much everything I do in the blog, when I buy, when I sell. I try to tell people when I've screwed up. Now, I still remember one of my favorite posts was on Vale, the Brazilian iron ore mining company, which I bought in 2012. When I bought it, I called it my 3C bet. Bet on a currency, a commodity, and a country. I bought it at $8 or $7 or $10 per share. And 2 years later, it was trading at $4 per share. Why? Because there are things I missed about commodity businesses where there's a lagged effect of commodity prices going down. I missed the fact that country risk can be bad and can get worse before it gets better. And that when country risk goes from bad to worse, currencies get dragged down. There's a correlation across the three. And I wrote a piece. I sold my Vale and I wrote a piece, no mas, no mas. I heard from my Portuguese reader saying that's Spanish, not Portuguese. But I was borrowing from this old Roberto Duran. I don't know whether you've heard of this fight where he was a boxer and at the end of the first round, he was one of the greatest boxers of all time against Sugar Ray Leonard. He said, no mas, no mas. Basically, I've had enough. And I said, I've had enough. And I talked about what I'd missed and why that translated into a mistake. But I didn't say never. I said, I never said I will never buy Vale again. I said, I'm leaving now, but I might be back in the future. And the minute I put that down on paper, it was a release because it basically meant that I was free to come up with a new story for Vale. So for me, and this is why I value Tesla every year. And I've admitted when I've screwed up on Tesla and I said, I missed that on Tesla and I'm going to go back and put it in, is being wrong is part of this game. And admitting you're wrong. The three most freeing words in investing are I was wrong. Because the minute you say that, you can think about what can I do instead. If you refuse to say that, and there are active portfolio managers who refuse to say the word I was wrong, it's almost impossible to fix your mistakes.
What are your views? One of the things we talk about a lot on the podcast is this idea of factor investing. And I can probably surmise your views on value based on what we've talked about so far. But what do you think about that in general? I mean, there's tons of factor funds out there. There's momentum, quality, lots of people following it. Do you have any views in general on factor investing?
It's funny because many active investors like to dump on academia, right? But factor investing had its birthplace in academia. I mean, you can go back and write the history of factor investing as starting with Rolf Bunz looking at small cap stocks in the late 70s, but most critically to the Pharma French paper in 1990, where they looked at data over 60 years and concluded that two factors explain difference in returns. One is market cap. Small market cap companies earned higher returns than large market cap companies, and low price to book ratio companies earned higher returns. Those factors still are in there, size and price to book. Now, but in the 1990s, you had an explosion of more and more data. Data on a second by second basis trade. And when you have more data and you look for things that explain returns, guess what? You're going to find them. Well, I think it was Campbell Harvey who created the term factor zoo, which is you are going to find more and more things work in creating, and using the title of your podcast, excess returns historically. It's interesting, though, that the birthplace of factor investing was that Pharma French paper. But Pharma and French were actually very clear about what they thought about the factors. They did not describe them as a source of excess returns. The way they described them was they missed risks, that we in finance have somehow come up with a measure of risk that doesn't capture risk, that small market cap and low price to book are proxies for risk. Gene Farmer, is a believer in efficient markets. Nothing he saw in that data led him to do anything that different than what he did before, which is buy an index fund, let it ride. But it's amazing factor, in active investors who built their entire careers around factors. There are two things to remember. One is it's very US centric. I mean, I know people have tried the factors, but the data that is being used to get the bulk of the factors is US centric. You're saying, so what? The US was the most mean reverting successful equity market of the 20th century. so that the factors work. Maybe it was to do with the fact that you had a mean reverting market. You buy low PE stocks and there's mean reversion. What are you going to see? Over time, low PE stocks are going to move towards the average and you're going to make money. You take out the mean reversion, the harder factor investing disappears. So the first is it's US centric. And second is a lot of those excess returns are on paper. And people often say, well, how can you believe in efficient markets when you do all these things that make excess returns? I say it's easy. What percentage of active investors beat the index? Right? Take a look at SPIVA. You've heard of SPIVA, right? The S&P data service where you can see what percentage of active investors in each class beat index funds in that same class. Because if you compare active value investors to the S&P 500 over the last 50 years, they will beat the market. Why? Because they bought low price to book stocks, and low price to book stocks during that period delivered higher returns. The real test of active investing is not whether you can beat the index or beat the market, but whether you can beat an index fund built entirely around what you claim your philosophy is. And the SPIVA statistics are just mind-boggling. 85 to 90% of active investors underperform their respective indices. That's my efficient market. An efficient market is one that it's not one where markets don't make mistakes. That's the straw man that people like to use. Markets of course they make mistakes. They make some doozies. It's can you take advantage of those mistakes to earn more than you would have in an index fund? And the answer is, it's really, really, really difficult. So when people talk about factor investing, it is backward looking, it is mean reverting. And I think that they have to factor in a reality that the tides may be shifting, that the market may be changing. Now, I'll give you an example, the small cap premium. Do you know there hasn't been a small cap premium since 1981? I'm going to add that on as a data set next year, where I'm going to let you pick the starting point and the ending point for the data. And I'm going to put up the data from 1927 to 2023. Over the entire period, small cap stocks have earned about 3.5% more than large cap stocks, maybe even more, 4 or 5% more than large cap stocks. Think that's great. I should buy small cap stocks. But then I'll let you change the starting point from 1927 to 1950 to 1960. And you get to about 1977. Starting in 1977, there's been no small cap premium. Doesn't mean that small cap stocks never do better. It's that they win some years, they lose other years. So that's what I think we need to think about. What's changed about the market? First, the global economy is not US-centric anymore. 50 years ago, the US economy was the center of the global economy. Now, it is a big part of the global economy, but it is not 50% of the global economy. Second, you got disruption, technology, and globalization all playing havoc with what used to be mean reversion. Mean reversion used to be that if you're a steel company and your margins drop, they would revert back to what they used to be. Well, that might or might not be the case when you have disruption and globalization. So I think we have to factor in the very real possibility that the world has shifted under us. And if the world has shifted under us, many of the reasons these factors worked in the past are no longer in place. So investing based on factors, I'll give you a very honest reason why I think factor investing cannot deliver excess returns. I have a very simple saying I use in my investment philosophies class. If you don't bring something to the table, you should not expect to take something away. What are you doing in factor investing? You're basically screening, right? You're screening for small cap stocks, low price to book stocks, whatever your factor is. 50 years ago, that took a lot of work. You had to go collect the raw data. You had to put in the screens, often run them by hand. Today, I can run the screens on Capital IQ. Across the global universe of stocks, it takes me 3 minutes to do. What makes you think that screening for factors entitles you to special status to earn excess returns? An index fund, an ETF, can do exactly the same thing. If you bring nothing to the table, and many factor investors bring very little to the table, I don't expect you to take anything away. That's why I'm not a great believer in pure factor investing. I mean, you might add something to the mix that makes you different, makes you unique. I know AQR had this quality small caps. They said we want small cap companies with quality in addition to small capitalization. Maybe there's a qualitative component to that quality. We look at management, look at what they're doing. Now, I can see the reason why you might be able to earn excess returns, but factor analysis by itself is just mechanical. A machine can do it better than you can.
Another thing we've been talking about a lot on the podcast is this idea of market concentration. We're not in the most concentrated market we ever were, but we're certainly in the upper echelon of that. Is that something that concerns you a lot, the fact that the biggest companies are such a high percentage of the market right now?
It's not that the biggest companies, I mean, it's always been true, right? I mean, you might be familiar with the Hendrik Bessembinder study, which went back and looked at what would have happened if you missed the 5 best stocks, the 10 best stocks. And it's horrifying if you look at the number. I think if you missed the top 50, you earned less than the treasury bond rate. Stocks collectively actually underperform treasuries. So it's always been true that the biggest winners carry the market. Markets are heavily skewed. What's different about the last 15 years, it's not just the biggest winners each year account for a big chunk of the market. It's the same players every year. Whereas we go back to the 20th century, the winners kept shifting. So if you look at the last decade, it was the FANG stocks, Facebook, Amazon, Netflix, Google, Apple, and Microsoft. Now, of course, the Mag 7. And that's a little scarier because it's the same stocks year after year carrying the market. And if they do it year after year, they're going to become trillion-dollar companies, $2 trillion companies, $3 trillion companies. And the problem when you have companies that big is if they stop delivering the upside, it's very difficult for the rest of the market to make up for it. It's not like consumer product stocks can step in. And if the Mag 7 are flat for the next year, I don't see how the market is up 15%. Because that's how much value they bring to the market. It makes it much. But there are two things that I see coming out of this. One is, this is a reflection of an economic shift. Again, people think of this as a market phenomenon. Markets reflect what's happened in the economy. We're increasingly a winner-take-all economy. And I'll take two businesses. Take the hospitality business 20 years ago. Hospitality business 20 years ago had dozens of hotel companies. No single hotel company, even the largest one, was more than 6 or 7% of the total market. Why? Because you were restricted locationally. You were constraints on how big you could get. And then Airbnb came along. How big can Airbnb get? What's the upper limit? Car service. 20 years ago, the biggest car service company is probably a 0.2% market share. Largest taxi cab company, maybe in New York. And then along came Uber and Didi and Lyft. In business after business, we've created business models that can scale up to effectively not just get bigger, but have networking benefits as they get bigger, which effectively means as they get bigger, it actually gets easier for them to get bigger because everybody wants to be on those platforms. It's a natural consequence if you have winner-take-all economies that you're going to get winner-take-all markets. I mean, think of how much of your day, and I remember during the peak of COVID, when at that time the FANG stocks were dominating the market. They'd accounted for 20% increase in market cap over the previous decade. They'd carried the market, and people said, this makes no sense. I asked them to map out in a typical day how much time they spent on the platforms of different companies. You wake up in the morning, what's the first thing you do? You check your Apple iPhone. You're already in the Apple ecosystem. You ask Alexa what time it is So all through the day. And I said, think of how much of your day you spend in the ecosystem of one of these FANG stocks. One or more sometimes. You're watching Netflix in the evening and you're checking out your iPhone, your Apple and Netflix at the same time. I said, should it be any surprise that the companies that are essentially sucking up your time, those are the companies you spend your time on, are the companies that end up dominating markets. So I think what you're seeing is a reflection of how we live, how we work, how we interact, playing out in markets as well, is we're increasingly captive to these big platforms. And that's what you see play out in markets as well.
This is something I think about all the time because if you look in the history of the S&P 500 and you look at the top 10 companies by decade, there's usually significant turnover in that. And I wonder, are we going to still see that? I mean, are these companies so dominant now that changes in the future?
You could see it, but it might be another platform that replaces this platform. I think in a sense, I think in many ways, Apple's iPhone upended the world in ways we still haven't figured out. Let's face it, without the smartphone in your hand, think of how many businesses cease to exist, right? How are you going to call your Uber or DoorDash? In fact, I would argue that each of these companies should probably pay some kind of royalty to the smartphone business, saying without us, without you, we're nothing. So I think it's it's entirely possible, but I don't see a manufacturing company being on top of this pile anymore. I mean, you could get a Tesla and NVIDIA, which are partly manufacturing, but let's face it, NVIDIA is a design company, right? It designs chips. TSMC makes all the chips. Tesla is still perhaps the only manufacturing company in the mix. But if there's automated driving that's effectively in the cards somewhere, who knows what Tesla will look like? So I think that's why I said the 21st century economy and markets is very different from the 20th century. And that's one of the reasons backward-looking investing, where you're fighting the line. I mean, I still read the stories about the French generals who learned from the First World War and built the Maginot Line because they thought they could stop the Germans from invading them by having this line which tanks could not cross because that's what they were used to. And then the Germans just flew planes right over the wall and the whole thing crumbled in 2 weeks. A lot of active investing is you're fighting battles from the last century, when in fact we should be thinking about how do we fight the battles of the century we're in. And I'll tell you in general, I don't know what the right way to play this game is, but we need to be more adaptable, less rigid, more accepting that there are a dozen different pathways to success. Not right. It's in fact the exact opposite of all the things I said. Value investing became rigid, ritualistic. Right is we need the exact opposite of those to succeed in the market we're in right now.
Just one more for me before I hand it back to Matt. I want to ask you about the rise of passive investing, because this is something we've talked about a lot in the podcast. I mean, passive is rising and rising. Many people these days have their 401ks. They have regular deposits going in there. Those are typically going into index funds. And some people have argued that because maybe liquidity doesn't scale with size, maybe that's having an influence on the market. Maybe that's making the bigger companies bigger. Do you think there's anything to that?
I think there is something to the argument that passive investing makes momentum stronger because basically you flow wherever the market cap is highest and you're going to see it. No, but there's a reason active and passive investing has taken off, right? Let's face it, active investing has always been crappy. Always, through its entire lifetime. But for much of its lifetime, we didn't know how crappy it was. I tell people to imagine being in the 1960s, right? There were only active mutual funds. You put your money in an active mutual fund. You got one statement, maybe for a year, telling you what your investment was doing. No comparisons. No idea what the rest of the world is doing. And you said, these guys are professionals. They know what they're doing. I've trusted them. This is the right thing to do. Two things happened. One is we started to get information about how badly active investing was doing on a continuous basis. On your smartphone, you could say, hey, my fund is up 7%. The S&P 500 is up 12%. Second, we empowered investors to be able to move their money. Can you imagine moving your money in the late 60s from one brokerage house to another? First, you'd have to physically drive to that brokerage house. You'd have to talk to the person at that desk who was going to convince you that this was the worst decision you could ever make. I guess if you insisted, he would still have to let you liquidate, but it would have been a long, drawn-out, expensive process. Now you're sitting at lunch, you realize your mutual fund is underperforming the S&P 500. Here's what you do. You sell your fund while you're at lunch. While you're taking a bite of your tuna sandwich, you sell your fund, you move it into another fund. Two things happen. One is information about how badly active investing was doing became public information. We all knew. Second, it became easier for us to act on that information. The rise of index funds and ETFs can very clearly be linked to investors waking up saying, this isn't working for me. I'm paying somebody to deliver 2% less than I could have made by not paying that person. I mean, I describe active investing as the equivalent of Floods or Us, a plumbing company that if you call into your house because there's a leak, leaves a flood, and sends you a bill for it. You'd never pay the guy, right? Active investing, bad performance is caught up with them. I do think, though, that as passive investing grows, and it will continue to grow, this is inexorable. It'll hit a cap. The reason it'll hit a cap, it's true that as passive investing grows, there are fewer and fewer people looking for bargains, looking for mistakes. But we talked about efficiency. The reason mistakes are so difficult to exploit in markets is because other people are also looking for them. There's a tipping point where if too few people are looking for mistakes, you could argue that the magnitude of mistakes will get larger and that active investing is going to pay off again. So there's an ebb and a flow to this. And I think there will be a point where passive investing overreaches and active investors will come back. But it's the steady state is going to be about a lot fewer active investors than we see today. All those floors in Boston that Fidelity has, 2/3 of them they don't need. It's not great if you're in the active investing business because the business is going to get smaller. Remember, we talked about bringing something to the table. The active investors are going to be left, or people are going to be people who bring something to the table. And it's not going to be permanent. You got to be adaptable because you bring something to the table. There's an ETF already getting formed saying, let's replicate what this guy is doing. And they don't need to know what you're doing. They just need to know what you're buying and selling. They can look at your actions and reverse engineer what you do. And the next thing you know, there'll be an ETF doing exactly what you do, charging 10 basis points, and you can't survive with 10 basis points.
How do you think about if you just think of, and I'm not looking for any investments in the asset management industry, but it's kind of like introducing the mutual fund and selling that thing in the 60s is one thing, in the same way introducing the index fund and selling passive is another thing. Is there almost just like an entire reconstitution of just like the jobs and the ideas around this whole space?
Sales pitches, right? What's your sales pitch when you do an active fund? I can beat the market, right? So that's the only way you can sell an active fund. What's an index fund sales pitch? We'll match the market. It's an effortless pitch because they can deliver 100% of the time as long as they stay pure index funds. That's why I'm not a great fan of tilted index funds or index funds that try to tilt you towards small cap. They bring in factor investing into index funds. I don't want to beat the index by 30 basis points or 20 basis points. I just want to match the index. The advantage of investing in an index fund is you're going to have the Mag 7 in your portfolio always. You're going to have the FANGAM in your portfolio always because you're just investing in the index. The problem with being an active investor is if your active investing philosophy drives you there, you might not have owned any of the FANGAM stocks over the last decade. In fact, many old-time value investing strategies would not have owned the FANGAM, would not have owned the Mag 7. They're still wagging their finger saying, you guys are going to pay the price. Every day I read about how terrible this is, how the correction is coming any day now. When do you stop doing that? When do you accept the fact that you've missed out on the stocks that drove the market? So I think that the advantage of index funds is you're never going to miss out the big winners. They're always going to be there in your portfolio. And that's a big plus because, as you said, if we're in a world where winner-take-all companies are going to dominate the market, you can't afford not to have them in your portfolio at some point in time.
It's interesting because that's the end of another story. That's the end of another era for those things. And I'm starting to feel like passive investment management businesses and consulting companies are almost the only infinite businesses left. Can those run in perpetuity?
Really businesses though, because these are exactly what AI could replicate effortlessly, right? What exactly do you get as advice on passive investing? You walk in, you say, I'm 57 years old. I have $2 million. You don't need a person across looking at stuff. creating what you need to do is costless and effortless. The Vanguard index funds could probably be run with 20 people in the entire building, hundreds of billions of dollars. So it's not even an exercise in running a business. Basically, you are a very low-cost commodity provider. And you can scale up and try to make enough money on it, but you're never going to be as wealthy as the wealthiest mutual fund, the Fidelities, the T. Rowe Prices used to be at the height of their powers.
How do you think about this for yourself? Like, how do you measure or think about your own decisions, active, passive, or otherwise in your own? I mean, you document these publicly. How do you think about
I'm
your
an
own
active
performance?
investor, and I say, look, I invest actively because I enjoy investing. I invest actively not because I want to beat the market, but because I enjoy investing. Which means that when I invest, the one thing I have to do is remember the Hippocratic Oath, which is do no harm. Don't do things in your portfolio that could cause you calamitous costs. For instance, I diversify. I hold 40 plus stocks in my portfolio. That would be a no-no with old-time value investing where you said concentrate. No, why not? Now, people say, don't you feel confident enough in your big winners? No, I don't. You might, I don't. Because I know how many things I don't control. Imagine buying Marriott in December of 2019 because you felt confident it was undervalued. You might have been right. But 2 months later, COVID hit, and there goes your rightness. There are too many things I don't control. It's hubris to think that you pick the 5 best companies in the market. So I diversify. I try to buy undervalued companies. But here's the bottom line, though. If I get to be 85 and you came to me on my deathbed and said, you know what, you could have made 50 basis points more or 25 basis points more a year by investing in index funds, instead of doing what you did, value companies and buy cheap companies. And you ask me, are you okay with that? My answer is yes. I'm okay with not beating the market. And that, I think, is critical, because if you keep telling yourself, I did the right thing, therefore I should beat the market, therein lie the seeds for being righteous, for being indignant, for getting angry. I mean, when you get angry at markets, nothing good comes out of it. And if you think about it, there are a lot of people out there very angry at markets, they're very angry at other investors, they're very angry at what other people do. And my response is, you're wasting your time and your energy, and it's sucking up what you should be doing on your own investments. So if I end up underperforming the market, I'm perfectly okay with that. Okay? Because I had a good time picking the stocks I did, and I did in a way that I'm not going to underperform the market by 5%. Because I'm spread out enough, I'm going to underperform the market by 15 basis points. Luckily, I've been lucky. I've been on the right side of that divide. But I'm also open to the possibility that it had nothing to do with my valuation skills and everything to do, which is, I bought NVIDIA in 2018 at $27 per share. I would love to tell you it's because I saw AI coming. I didn't even have the remotest clue about AI. I just bought it because it looked undervalued to me. I got incredibly lucky. I own all of the Mag 7 stocks. Tesla, I rebought this year because I bought and sold Tesla. And it hit 180, and I'd valued to 180. I bought it at like 171. Every other one of the Mag 7 stocks, I bought at a different point in time. And every one of them in my valuations has been undervalued at least 2 or 3 times in the last decade. And these are the most successful companies in the market. So when people say, I could never buy a Mag 7 stock, it's never undervalued, that's not true. I mean, think of Facebook after that metaverse fiasco. You could have bought Facebook for 5 years of online advertising cash flows. It's the closest I've come to the old Warren Buffett American Express investment in the 1960s after the salad oil scandal. The legend is he computed the cash flows he could have got from the card as a franchise and said, 5 years of cash flows gets me to the price I'm buying Amex. Meta was the American Express of this generation, if you were willing to look there. But people said tech companies, they'll always be expensive. I'll never buy them. Never is a dangerous word in investing. I'll buy any company at the right price. No. So company right now might be overvalued. Doesn't mean I will lose interest in it. Doesn't mean I won't buy it. So when you look at companies, I think you need to keep an open mind.
When you think about this, it feels like you're writing these books. What you're putting on YouTube is the entire new book on YouTube. Like, are you trying to bring this joy in the act of doing valuation work? Is this part of your broader
Everything
mission?
I do is in the public domain. In fact, it's kind of terrifying because everything I've ever written, everything I've ever taught in the public domain, it's terrifying because of, and I've talked about this in other domains. But 5 weeks before the spring semester of 2024 classes ended, I got a call from a friend of mine. In fact, I'm writing a blog post about this. His name is Vasundar. He teaches machine learning. He knows more about artificial intelligence than I will ever learn in my lifetime. He called me and he said, I've created a Damodaran bot. And I said, a what? He said, a Damodaran bot. And I said, what is a Damodaran bot? He said, I've created this AI entity that has read every single blog post you've ever written, watched every single YouTube video that you've ever put on, which means it's watched every class. It's looked at every evaluation that you've ever done. And it remembers everything that it has. And it's ready to go. And I said, ready to go where? He said, it's ready to value a company. Can you give me about 20 students from your class so we can run a contest of the bot against them? I don't have the final results in from that contest, but I'm terrified either way, because if the bot works really well, that's about as clear a signal as I can get that redundancy is around the corner, right? If the bot does really badly, it means that everything I've done in my life is about teaching how to be, that's not working, because this bot has read everything I've done and it's confused about valuing companies, and clearly I'm not doing my job. But the piece I'm writing is act as if there's a bot with your name looking over your shoulder, watching what you're doing. Remember, you don't have to be even the public domain like I am. It's watching what you're doing. And ask yourself, what can I do that a bot can't do better? And that, I think, is going to be the challenge for those people who think AI is going to change the way we work and live, is if your job is mechanical. That's why factor investing, completely mechanical. If what you do is mechanical, rule-driven, bot can do it much better than you can, because machines are better at mechanical stuff than you and I are, and they follow the rules. They'll be absolutely fidelity to those rules. So whatever you do, take a look at what you do and ask yourself, we talk about moats, right, in investing. My question is, what's your moat against your bot? What is it that you do that you don't think you bought? And it's something that's occupied my mind for the last few months. In my piece, I suggest a few things we can do, and I think that that's something that each of us has to think about. What can I do to keep my bot underperforming what I can do as a person?
Well, keep your bot out of the Berkshire meeting for starters.
Absolutely.
But I also like to think that, you wove together. I mean, we got, what did we have? We had Kenny Rogers, we had the Margino line, we had a boxing reference. There's a unique ability to blend stories in a way that I'm not saying the AI bot can't come up with novel ways
I
to
do
do
think
this,
you're
but
onto something. I think that there are a few things that human beings do that makes them difficult to replicate. One is, we do make connections out of things that look unconnected and come up with insights, right? And Galileo was sitting, Newton was sitting under an apple tree, an apple falls on his head. Instead of cursing the apple, he thought of gravity.
Take that, Newton bot.
Exactly.
Right?
Archimedes jumps out of a bathtub, runs naked through the streets. Because again, massive insight, right?
Do that, NVIDIA.
But that requires, I know through time we've inveighed against, an empty mind being a devil's workshop, but let's face it, an empty mind is where those connections happen. I call those aha moments, where you connect unconnected things and you say, aha, that's what we get. But I'll tell you what worries me is we have fewer and fewer empty moments in our mind, right? Imagine 20 years ago, you were standing in line at the bank. What did you do? Absolutely nothing. You had an empty mind because you had no choice. Now what do? You got your phone, you got checking your email, you're checking the news. We are filling every moment with stuff because we think we're being busy, and being busy is productive and being not busy is not. But I think that, unfortunately, I think those are the times where you're going to make those connections that a bot cannot make. So so my suggestion, I keep getting asked by people, what should I read next? And my advice is always throw some off and say, read less, think more. We read too much. We live in a world where we can read what everybody has ever written about everything. We can watch what anybody. No, we don't even give our mind a chance to think through things. No. And I think that might be our hidden power as human beings, that capacity to make connections across things. And I think we need to nurture that, because evolution is a magical force, a powerful force. We don't use stuff, we lose it. Right? And I'm afraid we're going to lose that power to make connections, to reason, because it's become so easy to look up answers to things and to fill our minds up with other things.
This is why I'm hoping we never get to the point where AI Matt and AI Jack are interviewing AI Aswath, because there's so much value in this conversation. I hope it never goes there.
But hope alone is not a strategy, right? We need to actively think about, what do we do as human beings that's not mechanical, that's going to be difficult for a machine to replicate. And that's why I said it's going to be different for each of us. So act like I have a bot with my name on it, and everything I've ever done is in the public domain. So I'm probably a unique experiment. But act like there's a bot coming for you which knows everything that you do. And then say, hey, can I outwit my bot? Can I do something that my bot cannot do? And I think that's, unless you actively go out there and create moats, they're not going to magically appear, right?
So let's get one more question in for you. We'll go out on this one. Based on all this experience in markets and teaching students about markets, if you could teach one lesson to the average investor, not just the students, but the average investor of the world, what one lesson would you want to teach them?
I think it's a lesson that increasingly is getting lost. Investing is about preserving and growing wealth. It's not about getting rich. And I think it's somehow, these days of YouTube celebrities telling you can get rich again. I was just watching a PBS documentary on crypto and how people want to hit the jackpot. I think that going for 10 baggers, 100 baggers, again, think of how much we go after those. That's not the name of investing. Is about preserving and growing wealth. Would I like to grow wealth at 50% a year? Yes. Would I like to have a 100-bagger in my portfolio? Yes, but I shouldn't be actively looking for those things, because if I look for those things, I'm going to miss the core tenets of investing. So I know it's tough to follow when people around you are getting rich effortlessly. The guy who bought Bitcoin at 100 and sold it at 5,000, you say, I'm working so hard to get a 15% return a year, and there he made 50 times what he. I think that's why looking at other people, letting envy drive what you should be doing as an investor can be extremely dangerous. So keep your focus on preserving and growing wealth, which means you need the income to create the wealth. So if you're a doctor, go back to being a doctor. Don't spend your lunchtime looking at what stocks are doing, or what your portfolio is doing. Read up some medical stuff. If you're an engineer, be an engineer first. Live the rest of your lives. Don't let investing become the center of your universe, because you need the income from whatever you do to create the wealth, which you can then preserve and grow. But in a world where markets, and I think that watching CNBC all day is a recipe for a terrible investing philosophy. So spend less time kind of tracking markets on a minute-by-minute basis, reading everything that's happening. Go back to living the rest of your lives and let investing do what it's supposed to do, which is take the wealth you accumulate from the rest of your life and preserving and growing that wealth.
Aswath Damodaran, thank you so much for your time today. You're watching Excess Returns. Subscribe, all the things below. We hope to talk to you again soon.
Thank you. I hope to be back.
Thank you.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.